All right, welcome back to another episode of More Than a Mortgage, where we help clients, realtors, people, homeowners create wealth through real estate. I'm here today with my man in crime, Tom Merritt, and partner in crime, I guess you'd say. And how's your summer been, man?
Whew, summer. I feel like it's almost over. It's flown by. It's been crazy, but it's been great. Lots of time. I was talking to some people earlier today. When I first had my boys, I was told that basically you got 14 years with them, because once they turn 14, they don't want to hang out with you, and then at 18, they go away to college. My boys are 14 and 15, so I've really been focusing this summer on doing whatever I can to spend as much time with them. So last few weeks, wow, we went to our Hockey and Sons hockey camp. The last year for my oldest son, he's aging out. We've been there for 10 years to take them from when they were 4 and 5 to now 14 and 15 and play hockey with them. We get on the ice. I'll tell you what.
You were playing hockey with them?
We were on there 4 times a day.
No, thank you.
Yeah, right? So I can tell you, I came back bruised and battered, not just physically, but the ego as well. They took it to me. So, yeah. So, but yeah. So
you guys were just down in Texas, too, for the National Championship for hockey, right?
we did. We followed up the camp up in Minnesota with a little floorball. Big European sport, not so huge over here, but my boys have been playing for quite some time. So we went down to Austin. Little side note, we were down there for those floods. It was crazy seeing those floods, the water that rose so quickly. Very fortunate to be in a safe spot, but the devastation was unbelievable. Like, have you ever been on rapids, like Category 5 rapids? That's what it was like. It was really surreal. But
Sad. Wow.
yeah, thoughts and prayers out to everybody out there. But it was a very successful weekend. We were able to capture the national championship. It was 4th year in a row. So pretty crazy.
Congrats to the boys. I love that.
Yeah, I appreciate it. So what about you, though? What have you been up to?
Same. It's just flying by. I mean, you're 14 and 15. I'm 4 right now. So, we got T-ball practice where you see a batter hit the ball and every single kid on the field chases it, including the batter. So it's very humorous. So we have wrestling camp not too long ago that the 4-year-old went to. He loves basketball. He's got the first, he wants to play football. He's just not old enough yet. So just love sports. So that's pretty much what my summer has been about. I know that I got 10 more years according to you, but I want to get it all in and soak it up while it's here.
Absolutely. Special times. Take advantage of it. Enjoy it. Embrace, because it goes like that.
Thanks for that advice. Well, one of the things we want to talk about and discuss today was the myths behind real estate, the mortgage business. Like, we hear it all the time.
So many myths. It's crazy.
I think the number one, I was in a room with there's about 60 first-time home buyers. We were doing a little presentation on what it takes to buy. And I said, how many people in this room think that you have to have 20% down to buy a home? And I kid you not, every single person in that room raised their hand.
Not surprised. Yeah, it's because that's what their parents probably said.
Exactly. So give me a little insight. Is that a factor?
Absolutely not. The reality is that comes back, like we talked about, from the parents. Back when they were buying back in the 80s, interest rates were like 15+%. Private mortgage insurance, PMI, which is probably why they said put 20% down, because that's the marker to eliminate it, was super expensive. But times have changed. The reality is, one, private mortgage insurance isn't very expensive. Number two, you're no longer in your property for those 30 years. As a first-time home buyer especially, you are not paying off that mortgage. Sorry to break it to you. You have more opportunity to create wealth and return on your investment by actually putting less down. Granted, my little caveat is, as long as you're comfortable with the monthly obligation, putting less down is actually advantageous to creating more of a return on your investment and wealth. So
6 to 8% is like kind of the average for a first-time home buyer to put down in today's market. So
it is. With a conventional loan, kind of your standard run-of-the-mill Fannie Mae, Freddie Mac, as a first-time home buyer, you're eligible for 3%. Perhaps you're not comfortable with that, but 3 to 10%, I think, is kind of the range from a first-time perspective, and it really gives you that opportunity to invest in the property, pay your mortgage, but really where you're going to create your wealth and your return on your investment is going to be from the appreciation that you're going to find over the course of whatever that is, 3, 5, 7 years.
So talk a little bit about the PMI. You mentioned that earlier. Is that a lot of people feel like it's a waste of money? It's expensive. What's going on with PMI these days? Just so you know, it's an acronym. Private mortgage insurance is where you don't put 20% down. You have to actually pay insurance coverage on the mortgage for any default opportunities down the road. The lender requires it.
Next podcast, let's do the acronyms. PMI, DTI, LTV, tune in. But no, for this one, so private mortgage insurance is essentially a monthly obligation that you're required to pay in the event you don't have 20% equity, whether that's through the down payment or perhaps over the course of time, your loan relative to the value of the property. Again, back in the day, it was super expensive, whereas really, especially if you have strong credit, it's really manageable. I mean, I've seen private mortgage insurance as low as $20 a month or less. That, as opposed to putting down an additional 5, 10, sometimes 15% more on a $300,000, $400,000, $500,000 home, and that's a lot of money. We're talking upwards of $50,000 to $75,000 that you could keep in your pocket, invest in some type of other investment vehicle to create a return while still paying, say, that extra $20, $30, $40 in that private mortgage insurance, but having your money work for you and create that wealth.
So that's a great point. And that also leads me into something else that we hear a lot of is it's one of two things. One is I've got to pay off all my debt before I go out and buy.
Yeah.
Or two, my student loans are like $150,000. There's no way in the world that I can buy with that kind of debt hanging over my head. So what you just said, putting less down and having that cushion there makes a lot of sense. But is that really true? You want to pay off all your debt before you get in? Or, it's nice to be debt free when you go through this process or have low debt, but tell us a little bit about the student loan piece and that fear around that.
Yeah, I think everyone looks, for the most part, at an aggregate, right? I've got $150,000 in student debt, or I have $50,000 on a car loan. But really, what we're looking at is what's your monthly obligation? What do you make each month, and what are you spending each month? And the reality is it's all monthly because you're going to be paying rent or you're going to be paying a mortgage. Can you afford or handle that monthly obligation? And so whether or not you have $5 in debt or $155,000 in debt, it's what that monthly obligation is. So how do you counsel people with regards to that?
I mean, we were fortunate enough in our market to be able to keep people at a manageable debt to income ratio scenario. So we look at like what their overall debt monthly looks like to what their income looks like. And we run a budget. It's important to run a budget while you're going through this. And, at the end of the day, it's all about what you have left over. Like, are you able to save? And so if you have $200 or $300 of student loan debt and a couple of credit cards, it's okay. As long as that number looks good for us and we're putting you in the best position to save. We're not about putting people in a house poor situation. We want them to be able to save. We talked about this, I think, on a previous episode, where it's 20 to 30% of their take home. That's important to us, right? So looking at all that, the debt becomes nominal at the end of the day. Yes, do you want to pay it back? You do, but you will over the course of time, right?
Absolutely. And I think, again, the whole basis, going back to episode 1, as you mentioned, of our show is to help and find different ways to create wealth. Well, this is one of those pro hacks, if you will, with regards to creating wealth. Instead of putting that 20% down, as we mentioned earlier, utilizing those funds to invest in other vehicles helps to create it. Similarly, with student loans or any other type of debt, making those monthly obligations and obviously recognizing that you have those payments, but not necessarily rushing to pay them all off before you invest. Utilize your money, both pay that off on their time frame, but also invest, whether that's in the house, whether that's in other vehicles to create a return. So you want to build it.
I love that. Those two to three myths we just talked about that we just debunked for you. How about this one? I love this one. I've got to have the lowest rate is the best.
Oh, geez.
We hear that a lot, right? I mean, well, talk a little bit about the lowest rate, because if I wanted to get someone the lowest rate today, I could get them like a 4.99%.
4.99, sign me up.
But it would cost you $300,000 or $30,000 on a $300,000 loan. So
yeah,
talk a little bit about the points and the buy downs and what people think the perception of low rates looks like.
Well, and I think obviously you being in the industry, you understand it, but that's probably, and we had this, one of the biggest frustrations of our industry is that the media and people always talk about, oh, you got to get the best rate. The problem is interest rate is just one component of the whole picture. There are costs associated. Many people, when we sit down in our consultative approach, as I know you do the same, are amazed to know that we get interest rates from, like you said, probably 4% all the way up to 8.5%, and every eighth of a percent in between. And at every eighth, there is a cost or a credit associated with it. And the thing is, and you could pull it up right now, I challenge you, pull up Rocket right now, pull up Wells Fargo, they'll all tell you what's today's rates. But then off in the little small print on the side, it says, assuming X, Y, and Z. And those X, Y, and Z are obviously picture perfect situations, 25% down, single family home, but also a certain number of points or costs associated with it. So when you're dealing or talking with clients, how do you help them to understand that it's not all about the rate?
Well, yeah, I mean, you got to look at if you want the lowest rate, you got to look at how fast your recapture time is to buying that down. In today's market with the margins on loans and where things are at, it really doesn't make a ton of sense to buy a lot of points. Because the break even on it is anywhere from three to 5 years, depending on your scenario, if not more. So you're basically banking on the market not improving in the next 3 to 5 years. A refinance, and I tell people this all the time, is much cheaper than paying 2 points to buy your rate down in the low sixes right now.
100%.
I think we all agree rates are going to come down eventually. They always do at some point. You know, this has been a drought for us over the last 3 years where they've stayed as high as they have. But we believe that with the new administration, like them or hate them, they're very vocal about getting rates down to help the homeowners out there in the market. So I don't know. I'm not a big fan. I maybe a little bit to get you down some if it makes sense, but you got to look at that cost versus your savings and when the recapture period is.
Well, and I think that to piggyback that, I think a lot of people are thinking, well, if I have to wait for 1%, which is another myth, if you will, for the rates to go down before I can refinance, then that could be a long time because they've been at the same level for at least, as you mentioned, 3 years. What do you say saving 1%?
That's a myth. I mean, it usually makes a lot of sense when you get down at least a half. We're always looking at how fast do you recoup your cost. And on a refinance, if you get down to 0.5%, if depending on your loan size, it's usually 12 to 15 months that you'll break even on something like that. So everybody's situation is going to look a little different, but that's why it's important to work with someone that you trust. Because there's a lot of predatory lending still out in our market right now. There's a lot of online guys and they're charging enormous amounts of points. I see it every day with my past clients. They call me, hey, does this look like a good deal? No, it doesn't. That's insane. So you just got to make sure that you know what you're looking at because the average homeowner typically doesn't.
Yeah, and it's a case-by-case situation, again, which is why you want to sit down, have someone that you trust and talk with them to figure out your situation. The reality is if you have a $100,000 loan and your rate drops by 1%, you're maybe saving around $70 a month. Whereas if you have $1 million loan and your rate drops 1%, you're probably saving close to $1,000 a month. So what is material for you? We try and use it more based off of what are you saving, not how much are you reducing your interest rate. For most people, it's usually around $150, $200 a month, where it starts to make sense because that's real money. Obviously, we take into account what are, if any, costs, what is the break even. But, again, I don't think it makes sense to refinance at 1% with $100,000 loans, whereas 0.25% could make sense at $1.5 million loan.
Totally.
So it just depends on the situation.
And that's a whole other episode. We could talk through that, but there are ways to refinance the right way and what to do with your money afterwards. So that's something I would love to talk further on down the road, especially since we know they're coming around the corner.
Yes.
How's a smart way to do a refinance? And again, it's who you sit down with and you talk to. If you love your loan officer, you've worked with them for a long time and you trust them and they're always giving you great advice, that's what you want. You want someone that will take care of you and give you the advice to lead you down the path. Any more myths that you're working off of right now?
Well, I don't know if people would think that this is a myth, but this is, for me, I think it's a big myth, and I want to get your opinion on it. So what I've heard is we need to wait for either the market to crash or for rates to come down before I'm going to do anything. I personally call that a myth, but I don't know. What are your thoughts?
I mean, there is a thing out there called locked buyers right now. And we believe from everything that I've read from all the experts out there that when rates get down to a certain threshold, the inventory is it's not going to create more inventory. It's going to create more activity, and the competition is going to be a lot more fierce. So we've got real stats around that, but I think they said rates get down to 6.25. There's like 6 to 7 million homeowners that would be likely to sell that are down around 5.25. So it doesn't mean there's going to create more inventory. It's a one-to-one trade-off. We think it's going to create even more competition and drive prices up even higher.
So you're driving costs up because there's more competition. That makes a lot of sense to me. The thing is, if we're waiting for rates or for it to crash, one, it doesn't sound like that's going to create a crash. Two, you're waiting for interest rates to come down. If you're waiting for interest rates to come down, that's only going to mean your cost is up. So where my myth comes into play is buy sooner if you're planning on it. It has to make sense for you individually, because then you lock in that price. Interest rates fluctuate over the course of time. We just talked about potential of refinancing. If you buy a house at $500,000 and in a year or two from now, rates go from say 7% to 5%, you can refinance. But if you wait to buy that $500,000, what I hear you saying is in a year from now, that house is now going to be $600,000.
Potentially, yeah.
So it doesn't matter if your rate's 5%, you're paying more.
It'll level out, right? So that's, I think, the biggest misconception that people are making right now is that you can't time the market. It's time in the market. You got to get out there and do what's right for your life and your situation. I mean, we see a lot of people making moves right now, not because they want to give up their 2.5% rate, because they have to or they want to. They want more space. They got the family now. They got maybe a divorce. There's a lot of reasons why people move, but don't base it on the market. Base it on like what's right for you. And that's, I think, the way to play the real estate game.
100%. And I think that that's starting to come through just with the longevity of the rates being in the higher range, if you will. You know, at first it was like, well, I'm going to wait. But life takes over, right? I call it the 4Ds: death, divorce, diamonds, and diapers. Any one of those four, that is when usually a move is going to precipitate itself because of those things. And so if you're experiencing them, it doesn't matter what the rate is, you need to essentially move.
I love that. And so if you're having that, like, you doubt right now, or you're like, my student loans are heavy or rates are just too high, have a conversation. You know, focus on the payment. Focus on what fits your finances the best, because we can look back from like 1950 all the way up until today, and real estate has always been a proven investment that has operated and functioned very well for people's portfolio.
100%. We've only seen 2 years of actual depreciation, 2008 and 2009. Every other year has been flat or positive.
Across the country.
Across the country.
Yeah.
Yeah.
So good stuff. Well, hopefully this resonated with some of you out there and the myths that are surrounding our industry. If not, if there's anything else that you want to talk to us about or have a question around myths that you've heard, drop us a comment. We'd love to answer those questions for you on an upcoming episode. Follow us on social media. We're on Instagram, Facebook, YouTube. So definitely follow us, like us if you enjoyed this episode today. We'd love to hear any comments that you have about the show. And Tom, gosh, it's July. The summer is coming to, it's going fast. So
that's right. Enjoy the summer.
Enjoy the summer. I'm Mike Black.
And I'm Tom Merritt.
And this was More Than a Mortgage.